Hi all, this is Akshara Menon from PMS Bazaar. A warm welcome to today's webinar. If you've been, tracking markets lately, you would know it's been a bit a roller coaster ride. We have seen FIIs selling consistently and reacting to the global rate worries and the geopolitical headlines, whereas the DII have been stepping in and backing the India growth story when the volatility says high. At the same time, there's a lot of happening beneath the surface. Recent news around India's supply chain dependency, efforts to map the critical imports and shift in global trade partnership shows how closely our markets are plugged into the global system. What happens in global manufacturing, logistics, geopolitics stays there, but it is gradually come into our earnings, margins, and valuations, and back to home. And that's where today's topic really comes in. Second order thinking is about just going thinking beyond the obvious, not just asking FIIs are selling, so what? But what does it mean? What is the next? And who gains the next market share? In the fund management that often have a real edge. When everyone has the same data, same headlines, alpha comes from the thinking one step ahead, connecting today's volatility, supply chain shifts to tomorrow's business outcomes. To the lens we are going to look at it today, how second order thinking can help navigate markets more calmly. To explain this further, it's my pleasure to introduce our speaker for the day. Ms. Harini has a strong academic foundation and she has an undergraduate degree from economics, politics, and advanced mathematical models from New York University. She's also a chartered financial analyst. She has been a part of the capital market since 2013, starting a career with 2 years at US-based hedge fund before bringing the global perspective to the Indian markets. Currently at Tamohara, she focuses on evaluating investment opportunities and managing portfolio. The fun fact is that if she wasn't an investor, most likely should have been a food critic or a photographer. More about her, we can see in this webinar. So before that, I would like to give the podium to Ms. Harini, and also giving a disclaimer to the audience saying that kindly put your questions on the box that's before you, and these questions will be answered post her presentation. So over to you, ma'am. Before that, just a question or a industry thing, which is like out of curiosity. In an industry where women are increasingly, significantly increasing in terms of investor types, but we have very limited representation of being a fund manager or the top CEO, CFO. In global level, we have a lot of women players. But in Indian fund management part, the women fraternity has always been very minimal, hardly 2-3% of it. So why is that? I'm not playing a gender game here, but still, just out of curiosity.
So thank you, Akshara, for that very, very kind introduction. And, before we dive into our conversation for the day, on the topic of women investors and fund managers, I think it's a matter of time, honestly. Whatever trends we see happen in the West, uh, probably a decade, probably 15 years later, depending on what sort of category of trend it is, we see a pickup happening in India as well. So I went there, I got educated, decided to come back and start off as a woman fund manager over here. But interestingly, if you see 12% of the fund managers in US are women, but they have only less than 2% of the assets. So the number pretty much for India and US is also the same in terms of the assets. Of course, we could do with a lot more number, but I think I hope that there are more firms out there like Tamohara that give the support system for a woman fund manager to thrive. And just as an example, the largest fund at Tamohara is run by a woman. That's me. So in our case, the ratio would be different, right? We would be one woman fund manager, but a higher chunk of the AUM. So, uh, you know, we, I would just have my co-promoters and my CIO to thank for all the support for that. But I think that's changing. We can't have 1/3 doctors and 25% lawyers being women and just 2% fund managers being women. So that will also change as women start becoming serious about their own finances.
So time answers that question. Probably 10 years later, when we're going to have the same similar chat, I would expect that increase in number of female fund managers in the society.
Absolutely.
Thank you, ma'am. Thank you for that. And of course, over to you for the PPT.
Perfect. Thank you so much. So today we're going to discuss about second order thinking and how does it really apply to us as long-term investors. Before we go any further, let's define what is second order thinking, right? For the benefit of our audience. Imagine you're a goalie. You're a high pressure match, you're seeing a penalty kick being taken against you. What goes in your mind, right? And what are you going to do next? This is assuming, of course, you don't have Kabir Khan from Chak De India standing at the corner telling you what to do next. So imagine there is no external influence and you're just looking straight ahead and you're deciding what to do. The answer is obvious. You've got to dive, right? Any goalie would say that, hey, I'm so tiny compared to the entire length of the goal post. I should dive. That's 96% of the time the goalie dives. And if you're a striker, what do you do? Well, the striker has, broadly speaking, three options. You hit in the top corners, right? Uh, that's almost like a high risk, high reward game. If the goalie gets it, great. I mean, if the goalie, if it goes into the goal, great. If not, then that you've just missed it and you're going to get booed in the stadium. But the goalie is never going to get to the ball if you get the top corner in. The second option is, and so that is like SME investing almost, right? The second option is you go to the sides, but at the lower part of the goal post. Uh, in that case, what will happen is you're playing it safe. You pretty much have limited your downside in a way because no one's going to blame you for playing a safe shot. Like you're never going to get booed because it's going to be on target. But there's a high chance that the goalie might save it as well. So that is almost like a balance advantage fund, so to speak, right? And uh, the other option is you just hit it bang in the center, right? Typically, we've seen, so if you look at studies that are done on like La Liga goals or EPL goals or even FIFA goals, you would see the distribution is even. 1/3 of the goals go in top corners, 1/3 of the goals come at the bottom sides, and 1/3 come in the center. But as a goalie, what are you doing? You are almost always diving, right? So, like I said, the striker is pretty even, Steven, 1/3 everywhere. The goalie almost always makes the decision to dive. Who would be a better investor, the striker or the goalie, right? If you're hitting it at the center, let's assume that these 1/3 strikers who are hitting it at the center have seen this data set that 95% of the time or 96% of the time the goalie dives. Let me hit at the center. It's a process driven, I've backed myself with data, I've backed myself with a process, and my probability of hitting the goal has just shot up, right? So the goalie has assumed the striker will find a gap, dives, that's first order thinking. A third of the strikers who anticipate that 96% of the time the goalie dives, hit straight, that is second order thinking. And no surprises that 70% of the time a penalty kick results in a successful outcome for the striker, right? So the answer is very evident. Strikers, aka the second order thinkers, typically make the best sort of investors. And it's no one's guess, or it's everyone's guess as to which one is the best category of striker. It is the third one, the one hitting bang in the center, right? So now let's take this concept and apply it to investing. What are the kind of questions we can answer for ourselves as long-term investors? When I say long-term investors, I look at investing in like, 3, 4, 5 year chunks. I would love to hold on to a company for decades, but we believe that structural patterns, tailwinds in an industry typically last for a 4-5 year cycle, and then you see some moderation in growth happening. So we think in those structural patterns. So how does second order thinking help in investing? Well, it answers two questions for us: what to invest in, and when to invest or when not to invest, right? So let's take up the first question: what to invest in. The first sort of thing to look at within that is it helps us look at shift in patterns a little differently. So if you see the stock price of the largest FMCG company in India, HUL, you would have pretty much written off consumption in India. You would have said consumption is dead. There's nothing happening here. And this is true for a lot of so-called quality consumption stocks in India. Sorry, before we go ahead, just a disclaimer that any stocks, indices that we may mention, we may or may not have a position in them. So this is strictly for educational purposes. It's not as a stock recommendation and should not be treated as that. So coming back to Hindustan Unilever, you're like 5 years, no money is being made. You know, if you see the volume growth in the company, it's abysmal. It's 3-4%. And this is the story all around, right? So you would think, okay, consumption is a dead sector. Why are we really looking at it? But think again. That's first order thinking. Think again. Are you consuming less? Are you consuming less versus your parents at similar income levels, right? So with every subsequent generation, and nowadays generation changes very fast. So every 5 years it becomes the next generation. The marginal propensity to consume has only gone up. So an HUL product I use is Dove shampoo. I have not started using less of Dove shampoo over the last 5 years. Once in a while, I will experiment with something else. But I'm pretty sure that our consumption of HUL products has not gone down for sure, right? So what is it? What is it about consumption that seems to be shifting? So we said to ourselves, okay, clearly we are consuming more than we used to, and more than our parents used to. Consumption is thriving, right? Look at our Zomato accounts, Swiggy accounts, the amount of food I order into the office. You can ask anybody in my office. So we started looking at what patterns have emerged. There's a lot more shopping that the newer generation does on quick commerce. A lot newer brands that people are willing to experiment with, right? So today's World Protein Day, out of the top 5 protein bars that we discussed in office today, not a single one is owned by a large FMCG company. So our consumption patterns have shifted, and HUL, as a result, has changed their capital allocation as well. So over the last 5 years, they have spent almost 3 to 4 times more than what they had in the previous 5 years on M&A and advertisements, right? So they spent 45,000 crores on M&A. There was a one large, big acquisition that happened. But even apart from that, they've been doing acquisitions like Minimalist, etc., which are in thousands of crores. And my A&P spends have also gone up. But when you are spending so much more on one side of expenses, you have to take that money out from somewhere else. You know, at the end of the day, the budget cannot exceed, the fixed line that has been drawn for it. So what have they done? They have reduced incremental capital allocation towards their own manufacturing. So assuming that more or less FMCG companies operate at 50% gross margins, we've seen HUL from outsourcing about 20% of their production in 2018 to outsourcing over 40% of their production today, right? So HUL itself has grown sales, let's say 10% CAGR in the last 5 years, but their outsourcing has doubled, right? So in the last 5 years, somebody who is catering to HUL's outsourcing demand would have actually seen growth of about 25% odd. It was a light bulb moment for us, right? Let's figure out who are these contract manufacturers. And if you don't believe me, you can look at the numbers yourself. HUL, ITC, and Nestle. These three make up the 3 largest FMCG companies in India. All of them have 10% sales growth, ballpark, and 5 to 9% profit CAGR, right? The contract manufacturer we spoke about has a 36% sales growth and a 37% profit CAGR. And if they've maintained share in their business with HUL, it is but natural that their top line from HUL itself has grown at 25%, right? So this in itself is a very, very stable business. And then, of course, they've been adding new clients as well. So why should we be saying consumption is dead? It's just that we need to think about what is actually happening beyond the headline that we always see. The company I'm speaking about is Hindustan Foods. Like I said, sales have grown at 39%, EBITDA grown at 44%. They've, of course, raised capital. They've done a massive capex last year of about 750 crores. So their earnings per share have compounded at 32%. But think about this. With over 40% revenue coming from a group of brands as strong as Unilever, why not play HUL through this, given the change in capital allocation, given the change that we've seen in the pattern in consumption? At 3 times the growth, long-term sticky contracts. These are all 9-10 year contracts that are in place. They're almost exclusive plants that they've been running for some of their large customers. And once this entire capex is on stream, they make about 18% ROE versus HUL, which makes about 21-22%. So at 0.75x the ROE, but 3x the growth, how should one look at Hindustan Foods versus brand owners? That was the question for us to answer as fund managers, as investors, not whether we should look at HUL or we should never look at consumption ever again, because we were very certain that the way we are consuming and the fact that our marginal propensity to consume has gone up versus our parents, we have to look at consumption in India. Let's come to the second sort of framework that we have in what to invest. This framework is something that we call picks and shovels. Whenever there's this big narrative that comes up in the investing world, large capital starts chasing it, right? There's this momentum that completely gets behind it, and in two ways. One is the direct way, where you see large conglomerates, unrelated conglomerates, announcing capex in that large theme, thereby diminishing the IRR of existing players in that theme. So case in point would be, let's say, everybody all of a sudden announcing that we are going to set up our own EV division, or we are going to set up our own data center, right? And the IRR that people were making in these businesses 5 years ago versus what they will now make would be significantly different. The second way the large capital chases big themes is, of course, investors. Investors keep pouring in money, and they diminish future returns for new investors coming in the sense that we may both agree it's a good enough business, right? The old investor and the new investor. But the old investor would have poured in so much money that that good enough business is now pricing great enough outcomes, right? So we want to stay wary of those narratives that sort of diminish IRRs or return on capital for us as investors. In both cases, in both these cases, it is important to look at picks and shovels, right? Because the theme, you believe the theme, you bought the narrative, you know that EV adoption is going up in this country, you know that there are more data centers coming up in this country. So you want to play it. We're not saying that you don't play it at all and don't look at momentum. It's a very useful tool to tell you where people are deploying so much more capital in, and it's serious money that's going in. But what happens is, when you look at picks and shovel, you have two big advantages. One, you can come up with a protected profit pool, right? A protected profit pool, and we'll discuss how this comes about, but it'll ensure resilience in return ratios. And the second benefit, which is great for someone like me, because I take a lot of time to decide on which company I would like to include in my portfolio, because we run a fairly concentrated portfolio. Second order beneficiaries catch fancy much after the bigger narrative starts moving. So it gives us a little more time as investors to investigate and then deploy, right? So let's look at the first example of companies killing their own IRRs. Even if you're living under a rock, you would have heard of AI. for sure in the last 3 months. You would have heard of data centers. Everybody and their cousin has announced a massive capex in data center, right? Every day we get sent like 2 notifications from a company saying that, hey, we are getting into data centers. And it's the new buzzword in town. And some people are genuinely putting serious money into it, right? So the first immediate reaction is, hey, if all the Max 7 are putting up data centers, let's go buy a data center company, right? Clearly, that's the way to look at it. And then let's look at the 2 largest data center companies in the US. These are scaled organizations at 60 and $90 billion market cap. So they're not small organizations by any metric. The peak ROE they've done is sub 10%. So they've not, at their peak ROE, they're not cracking into double-digit return ratios. They're barely, therefore, covering their cost of equity, right? So they've seen growth, but there's no ROE over there, right? So clearly what has happened is there's a lot of money that's come in, and it's just kept on pushing the return ratios lower and lower and lower over a period of time. Now, let's look at the picks and shovels. How do we really play the data center boom? Because we're convinced about it. So there are 2 examples I want to share. One is a company called Corning Inc. It is one of the most specialized glass manufacturers in the world. Uh, if you by chance are a user of an iPhone, you would have heard of Gorilla Glass. That is something that was developed by Corning Inc. Today, the most clearest form of optical fiber developed from glass is something that they have come up with, which ensures the lowest latency uh, amongst any other optical fiber option out there. This is a business that at $125 billion market cap does 15% ROE, and this is when they're in their capex and aggressive expansion mode. So they're currently trying to double their gross block that caters to optical fibers. Let's look at another company, Modine Manufacturing. They make heat exchangers. Heat exchangers are that critical component in ACs that give you a very, very good or bad star rating, aka it ensures the efficiency of your HVAC systems, and data centers need cooling at a significant level. This is also a company that's seeing 40-50% growth on their project side, doing 22% ROE almost, right? So what is the overall thesis over here? You find an engineering problem that throwing money cannot solve, right? So what we sort of call it in our colloquial term is it should not suffer from the AA curse, right? We don't want, it actually should be AAA. We don't want Ambani, Adani, or Amazon throwing money at this problem and solving it. So there are 2 ways to really look at it. One is there is just too much expertise that is required in this particular industry. So for example, if you look at heat exchangers, if the copper tubing that's gone into the heat exchanger has to be about 5-6 thin in thickness, right? You get that wrong by a millimeter. And with that amount of compressed gas running at 55-60 ton ACs that power data centers, there is a big chance of having a blast, right? So it's not something that you will wake up one day and get all the certifications done and get to have the entire engineering prowess behind you in that, right? The second way to look at it is this engineering problem a very niche one, or is this business a very niche one where large capital allocation would never make sense? So unrelated, but if we had to look at this, there's a diagnostics business in India. Every time people would come and say, so and so is going to get into diagnostics and set up a lab in India. The reality is that the entire gross block of the entire diagnostics industry in India is just about 2,000 crores. These are people who want to deploy 40, 50, 60,000 crores and earn FD plus returns, right? They're not going to get into a business where the entire gross block of the industry is so small, because for them, it will just be a distraction and not a meaningful allocation of capital, right? So the way to play any narrative, any boom for us is we find an engineering problem within that, which cannot be solved by throwing money at it. And we've all heard the common adage that stock prices are slave to earnings. I think, or earnings growth. I think we would like to rephrase it. Stock prices are eventually slave to quality earnings growth. All these four companies that we spoke about, the two data centers and the two shovel and picks, uh, they're companies that have seen significant growth in the last 3 years, right? But the stock price journey has been very, very different. The data center operators are flat, giving almost zero returns for the last year, whereas we're getting about 160, 170% returns on both Modine and on Corning Inc. So that is another sort of testament to the fact that, find the picks and shovel guys that have a protected profit pool, therefore protected return on equity ratios, and therefore can deliver growth in earnings, but growth in quality earnings. So let's get closer to home, a story that we would all know a little more, names that we would all associate with a little more. Remember how in 22, 23, it was told to us that EVs would cause oil to be worthless. Every uh, uh, other startup that was getting funded was a two-wheeler electric vehicle. There were the existing two-wheeler OEMs who were completely stumped in trying to figure out what to do next. Where are we going to invest? They'd all, of course, taken some investments in some brands out there, but they were just waiting to see where the dust settles, right? And I remember 15th August 2021, we saw the launch of Ola scooter for the first time, and the factory that it was made in, and we all felt that this was an industry whose time had come. But then how do you play it, right? If we had uh, looked at this sort of narrative and decided, okay, let's buy the electric vehicle OEM, well, that would be akin to trying to hit the ball in the top right corner of the goalpost, right? There is a very real chance that you'll just completely miss, or if you score, you scored really well, right? So if you see what has happened since listing of Ola and Ather Energy, which are the two largest EV OEMs that are listed in India today, Ather has done really well, and Ola has been completely decimated, right? But when you see beyond just these two companies, you realize what had happened. There were 350 registered manufacturers because most of them were able to source parts. We have a robust enough auto ang supply chain in India, and they were just about able to set up assembly lines and start a brand of their own. Uh, 70 of those 350 manufacturers had at least one showroom selling electric two-wheeler. So we could say that, okay, you could have taken a call on which one thrives, and if you got it right, you would have made a killing. But I don't like hitting the soccer ball in the top right corner, right? When I hit, need to know I will score, right? So the answer is very simple. All these guys are doing assembly. If they're new OEMs, but they're getting service with the same old Angs, why not just look at Auto Ang's company, right? Another tube light moment, and automatic headlights went on, right? So we looked at the most obvious EV agnostic, hybrid agnostic play that we could think of, which was headlamps. No matter which vehicle, what ignition is powering it, you need a headlamp to be fixed on it. And that brought us to our company, FIIM Industries. It is an auto anch with zero anchor clients that service all two-wheeler companies, all large two-wheeler companies, anybody that has more than 4-5% market share in the industry. There was an additional, so I used a phrase, automatic headlight on. That was an additional regulatory tailwind that came about with the Supreme Court ruling that the moment you hit ignition on a two-wheeler, headlights have to go on. Think about it. You're riding in Rajasthan, right? Playing some great interstellar music, but riding in Rajasthan, and it's 45 degrees out there. You're going from one town to the other, and it's going to be about an hour. At some point, the heat from that halogen bulb is going to crack the glass on top of your headlamp, right? And you're going to have to keep replacing that. So, as a result of this automatic headlights on, a lot of people started preferring to have LEDs installed as headlamps instead of halogen. The other big tailwind was every electric vehicle, because electric two-wheelers were premium to the ICE two-wheelers. My LED realizations, my LED preference went up, and LED realization is about 2x of halogen. So for us, it was like, hey, this looks like fairly simple maths. 2x of industry growth is possible. Let's just take a call if this guy can keep on maintaining and winning more market share. And the answer is yes. We saw 14% CAGR in revenues, a 24% CAGR in PAT, and the most beautiful thing of them all, the return on capital, the incremental return on capital just every year kept on improving. We went from 16 to 27%. It was the smoothest ride we could have had in two-wheeler industry, right? This is last 5 years. Look at FIM, which is the top, the bright blue mark, followed by TVS, which is the best performing OEM out there, followed by Eicher, Bajaj, and then Hero. We were just, instead of taking that call that who will crack this game correctly, we just took the call that, hey, incrementally, a lot many more people will be buying headlamps that are LED. So let's just take the Ank, which regardless of the energy transition wins, but with the energy transition from ICE to EV, wins a lot more. And ended up, getting a very smooth journey in two-wheelers without the heartache of, oh, there are no new launches coming. Oh, what is happening now? These Ather has launched this as a competition. Ola has launched that as a competition. None of that, because we serviced all of them. So coming to the last part of the framework, which is when things get priced beyond perfection, right? So this is more about when to buy and when not to buy, right? So you may be completely right on a business, you may be completely right on the narrative, uh, and the second order impact as well. But you've got to ask yourselves this derivative question. If I think it's a good business, but if the market already assumes it to be a great business, there are very little chances I'm going to make money in it. I need to then play it through something else. So let's look at this classic example. This is the most talked about pharma drug in the history, in human history for sure. This is also the most popular, the largest pharma drug there has been ever launched. So this was semaglutide. We know it popularly as Ozempic. It was launched in 2018. In the first full year of sales, it crossed $1 billion in sales. In 2025, which is 6 years later, we crossed $20 billion in sales. So there was a 20x in revenues, right? Hindsight tells us that, yeah, this was a no-brainer. This would have been a great investment. 5 years, you would have made a killing of a lifetime, because when revenues go up 5x, your cost structure does not go up 5x. So, in this case, the revenues have gone up 20x. So cost structure definitely didn't go up 20x. We should have definitely invested. Up. Not really, because clearly its own stock price started consuming the drug and lost a lot of fat. But jokes aside, you had a wild ride with Ozempic in the last 5 years. 5 years, you saw the stock going up 4x and then coming down 75% to end 5 year period flat. I mean, if you just bought this, and the stock, the drug has still not gone generic. Mind you, in US it goes generic, which is majority of the sales of Ozempic and Wegovy. It goes generic much later, 4 or 5 years hence. So if you had, bought this thinking you had this great insight on why this drug would continue to be popular, and then just forgotten about it for 5 years, because you're like, it doesn't go generic in even rest of the world by before 2026. So I look at it at the end of 2025. You would have made no money. But there was a second order change that happened. When a drug becomes that popular, let's understand what is this drug being consumed for. People are consuming this drug to combat obesity. Obesity has a lot of second order impact on your health. It increases diabetes risk, it increases hypertension risk, it increases chronic kidney failure risk, etc., etc. Right? So a lot of people were consuming this drug uh, to find a fix to their obesity, and therefore find a fix to their chronic health problems. Now, if this is the thesis basis which 12% of Americans have consumed this medicine at some point in the last 5 years, 12% is a massive percentage of the population to have consumed a single drug. And the answer is very clear. Everybody's going to ask for an ROI on their $20 billion worth of annual spend on these drugs. And the way to calculate ROI on these drugs is continuous testing. I need to figure out if my parameters are actually improving by consuming this drug. Largest diagnostics company in the US, in the meantime, has gone up 81%. So that's a return that's higher than, that's a dollar term return that's higher than even the rupee Nifty return that has come through in the last 5 years. So that tells you that if you, and you can see that it's been a much smoother ride, right? You would have never lost your sleep in owning Quest because they kept on consistently increasing their volumes. There was many more requests that kept on coming in for doing testing for data points related to chronic ailments. And if you're done invested in Novo Nordisk, which is the manufacturer of Ozempic, you would have been left with pretty much no returns, right? So this is sort of our thesis that we wanted to present to you today, that you really need to think of second order impacts and play those out in your portfolio for smoother journeys, right? You might have hit something in the top right corner, gotten it right, but that's not process driven. We want to hit straight in the center because we know the goalie dives 96% of the time, and we want to outperform at least that percentage of the time, right? And I am a recent mother. Value of sleep is very, very high in my books. So for me, I like to sleep really well, which is what we want to deliver via our performance. So this is our post-fee performance of our fund truffle. In every time frame 1, 3, 5, 7, because of our approach of looking at companies from the second order benefit, we've given consistent returns. And these are returns that you can, sleep well and get 8 hours of great sleep with that. So I think on that note, I would like to pause here and see if there are any questions that you may have for me.
Of course, ma'am. That was a brilliant PPT. I know I have a little few questions that I want to be answered by you. And before that, of course, congratulations on being a new mother. Even I know the value of sleep. Then I can completely resonate to that. So before that, let me start off with the very first question. Regarding when you started off the PPT, you just start off saying about an analogy of an plate. Matlab, it's like a penalty kick in. Yeah. In that sort, if the striker is going to score, if you're going to strike straight and goalkeeper goes sideways, it's a predictable from striker's end. But
Right.
if you're going to put it on the market, yeah, market wise, it's always unpredictable. So, when you say that, and how come the second order thinking comes with the unpredictable part? So, I felt it was contradicting. So, if you could answer that part.
Sure. So, the reality is that best of investors will have about 50% strike rate, right?
Mm.
The idea is that don't get it lower than that. Then you're headed for trouble because then you have to get your top corners all the time. At 50% strike rate also, if you can identify which are the times that you miss all the time or which are the categories you miss all the time, cut your losses short. With that 50% strike rate, you can create a consistent track record, like we would like to for our clients. Now, the dichotomy is that the goalie jumps 94% of the time, but at least 34% of the time, the ball comes straight at you. You didn't have to do anything. So you were prone to action 5 to 7 times more than what you should have been, right? So that itself is a very, very big gap. So it's actually not contradictory. It's telling you that you don't need to always sort of jump to action. You don't need to always be like, oh, I read this, let's buy this. you have the ability to take time and see what's happening, because you know statistically that it's a even split, right? So you're going to get it to at you at one third of the time. At least those are easy shots. Why would you not save those?
I think that's the probability. That's a probability
Correct.
check.
Correct. Right.
Good. And when it comes to second order thinking, what happens is that main part of it is that probably you might miss the winners, matlab the easy winners. Probably you might be late in accepting it, or because of it, you might lose that profit part as well.
Yeah.
So is that a risk that you see, or do you see it as an opportunity in second order thinking?
So we see it as an opportunity because we've seen that the movement in second order stocks would come a little bit after they would come in the immediate narrative driven stocks, right? So I'll give you an example, and maybe it's not a fair one, but since we discussed Ola, for example, prior to 21, everybody was gung-ho about Ola. You could have seen in the unlisted sort of stock price of Ola sort of just skyrocketing. Um, FIM only started sort of making the big move that it did of going about 6, 7x almost 9 months after the Ola announcement came in. And before the Ola launch happened, it was already announced that FIM is the sole supplier of headlamps for Ola, right?
Mm.
But market still gave you that 6, 9% because it was occupied somewhere else. It was, not really thinking of second order. Or if you saw the chart for Quest Diagnostics versus Ozempic, right? Of course, in the short term, you would have felt like, hey, I'm such a loser. Like, this guy's made 4x. But we can't ever assume that we're going to sell at top and, get in at bottom. But I like those smoother journeys, right? Because that's more consistent and I can replicate that as a process across all clients. Because PMS, you keep on getting money at every given point of time and you have to deploy it. And we don't do model deployment. So
Mm.
we want to make sure that we're replicating and keeping those tight portfolios across all clients. So we like such businesses because I'm trying to increase my percentage. Instead of 50%, can my strike rate go up 50 to 55%? If I can do that, I'll anyways be better off.
Okay, but even if we're talking about contract manufacturers, right?
Yeah.
I got to see from a PPT that you were talking about 40% from it. So when you say contract manufacturer are attractive today, yeah, what happens is that if the manufacturing become in-house?
Right.
So because when they can put money, so much of money, and to outsource that manufacturing part, they can easily bring it in-house or bring it internally. What
Right.
that brings in, so the attractiveness of that particular part would definitely wave off from this sector.
Right. So, Akshay, that's a very valid point. And honestly, when we bought into this company, so whenever we buy into a company, we write something called a pre-mortem.
Mm.
Post-mortem, everybody understands, right? An accident happens and you figure out what went wrong. Pre-mortem is you assume you're in the future and an accident is happening. Why are you regretting buying this stock? What are the possible accidents that can happen in this particular company? So the top accident we identify was exactly this, right? At some point, HUL will realize that, hey, this guy's making 18-20% ROE on my business. Let me just do that because why should I just leave that capital allocation on the table? The reality is this, though. Uh, your capital is finite. You don't have infinite capital. And HUL has a budget that it will be like, okay, I can deploy X amount every year. It will go back to the drawing board and ask itself, what am I good at? And the answer will always be at developing brands and distributing those brands, right? Unilever will never come back and say that I am great at manufacturing because honestly, making shampoos, ice creams, and all is a very commoditized business, right? They're going to come back and say, hey, we are great at brand building because customers trust us even 40 years after we launch a brand, right? So we need to, if that's what it takes to defend our market share, sales, so they will definitely not outsource. And the
Mm.
reality is that the way um, social media and venture capital funding has made it easy for new age brands to come up. And then, of course, with guys like Zepto, etc., it's very easy to come to market as well. These guys have realized that they will have to till the time this trend doesn't change, they will have to keep on fighting on the sales side. So they don't want to divert their capital from that. They also don't want to divert their attention because at the end of the day, they're an MNC. They'll be like at 6 p.m. we need to go home, right? So they're not going to get into everything.
Got it. So that this applies to big contract manufacturers, right?
Right.
Correct. And let me ask one question from audience is that from Vishal, any stock you have a big position and went wrong? If you could share your thoughts on it.
Yeah, so we have, I mean, like I said, strike rate is 50%, right? So we can't get every decision right. Uh, the the good thing is that because we are process driven, to the point where my team members hate me for it because I'm like, okay, you think I should buy it? Okay, the stock price has gone up 20% since you started working on it, but you've not answered my question. And they'll be like, oh God, like, can we just get on with this? Like, this is not how fast-paced markets work. But um, honestly, the big mistakes I've made are mistakes of selling early.
Okay.
There's a company that uh, I had in my portfolio called Solar Industries. Personally, if you ask me, that's the biggest mistake I've made. And the reason for that is very simple. In the sell note of the company, this is a business I've owned since 2017. Jan 2017 is when I bought into it. In the sell note of the company, when I exited the position, I wrote that valuation concerns, which was the only reason, right? So yada yada yada. And I said that I still believe this company will do 25% earnings growth for the next 3 years.
Okay.
And when I now read it in hindsight, if valuation was the only concern I had, but I knew that this company was doing 20% growth for the last 5 years, and for the next 5 years, I can see an acceleration to 25. The changes it does to your ROE, the changes it does to your balance sheet is just phenomenal. The changes it does to your ability to get bigger contracts, right? All of that is just phenomenal. Um, we just missed out, right? I mean, we were probably one of the earlier people to have bought a company that had anything to do with defense. In 2017, nobody was talking defense.
Oh,
And I sold in 2023. It was,
that was a very
because I thought it became too expensive. But in writing that note, I'd still written, I believe the growth will accelerate. So to me, that has been the biggest learning that, and that was a big position for me.
that was a regret also.
Sorry?
That was a regret also.
It,
Selling.
it, yeah, it's my biggest regret.
Okay. Of course, any of the stocks which has been taken during this video is not to be considered as any buy, sell, or hold recommendation, but still
Yeah,
just taken for the information purpose.
right.
So moving on to the next question, like for an individual investor, what practical habits can help to build second order thinking in a day-to-day decision making? It's like more of practical life, not into fund management.
So practical life, I'm going to give you very old people advice now, but I think the biggest thing, biggest advice that we all get from our parents the day we get married is, you know, even if you fight with your spouse, don't go to bed angry, or, like if you want to get angry, count till 10, right? If somebody does something to annoy you, first order thinking would be immediately react with anger. Second order thinking is put myself in the other person's shoe and try and understand, breathe, and then probably talk about it where you can actually find a solution. So, in practical daily life, that's the immediate example that comes to my mind. And it's all easier said than done. When you're angry, you're angry. Like it's just what it is. So,
But that's very difficult to do in a practical life, to be very
right,
honest. I think it's easy in fund management, but not in practical life. So
right.
you spoke of a lot of sectors like in FMCG, EV, pharma, most of it. If I could ask about IT, because that has been the talk of the town ever since Trump's tariffs part of it, and it has not done well in this month. I'm just taking very recent data. This month it has been very bad for ITs. So if there's any allocation to in your portfolio, and what is your outlook on that particular sector?
So, honestly, my outlook on IT has always been I don't like that sector. And I'll tell you why. It is not something you would have heard me if you had heard me speak in 2022 when IT stocks were at a high. I would have said the same thing. The reason is very simple. The philosophy that we put forward and that we try to stick to. We always say we are vanilla guys and we try to stick to vanilla. Our vanilla philosophies find businesses that are fundamentally growing faster than India's nominal GDP, and within those businesses who are gaining market share. Unfortunately, IT companies, or at least the large IT companies, fail on the first criteria. They're not growing faster than India's nominal GDP. India's nominal GDP is doing 11-12% growth. Nifty IT sales growth would not be 11-12% for the last 10 years, right? So it is not beaten India's nominal GDP. The reason for that is I know that it's not incrementally being as relevant in India's growth story as it was in the past. So, in my opinion, multiples have to start derating for that. And I don't ever want to be caught in a business where multiples can derate because there are only so many variables we can account for. Now, if you have to get this extra artistic thinking of what multiple can derate to, I mean, you're just increasing your work by too much. So, for me, IT services as a business was always something where I felt that um, this is a 9-10% growth business. So you can have maybe an opportunistic bet sometime, uh, but not something that I would buy as a structural bet for the 3-4 year story, because I don't ever see a 3-4 year patch where it has outgrown India's nominal GDP since I became an investor. I'm not talking of my neighbor who bought Infosys shares in 1992 IPO and all of that. Of course, they've minted money, and rightly so, because that time it was
Wasn't right.
accelerating growth faster than India's nominal GDP. So that is my take on IT services. IT products, they're all very niche, separate businesses, which maybe we can look at, but currently we do not have exposure to. Uh,
I,
right,
I
but yeah. So, but Akshara, having said that, I don't believe in the doomsday theory of AI. Taking away every single IT service job. I believe that I mean, you could have said that for retail as well, right? In the US, when the dot-com bubble happened in 99, everybody said, oh, offline retail is gone. Amazon
Mhm.
is, and etc., pets.com, etc.com is going to take over everything. And we are not going to see, the revival of offline retail. And all the jobs, because retail was the heaviest, it used to employ 17% of Americans in 1999. So all these jobs are going to go away. Well, guess what? We are sitting in 26. 2025 is the first year that Amazon sales, including AWS, including merchant sales, etc., prime sales, overtook Walmart for the first time. Walmart being the largest offline retailer that's there in the US. That 17% employment that was there, which is about 2.2 crore people, has come down to 1.5 crore people, but it has not disappeared. And this has happened over 26 years. So I believe that productivity, I mean, narratives come as a shock, but businesses will take their time to adopt these productivity tools and move on. And funnily enough, the first leg of adoption will be driven by IT services company, and which we saw in Q3. We saw all their TCVs really picking up as a result. So um, maybe it's a tactical call to take, maybe, but like in such a market, if I start taking tactical calls versus structural bets, when I'm getting great companies to like hold for 3-4 years, so yeah, so my negative view on IT is more on a structural basis, and it's been like that for the last 10 years.
Okay, look, it's a follow-up question because when you say that, as IT as a theme, you're not bullish on it currently, probably, and but it was if you were to talk, 15 years ago, probably you might have been bullish on that particular sector because of the rally that had. The theme that you want to speak is like pick and shovels, right? So
Yeah.
in that, it's more like you're avoiding thematic
Hmm.
investing. That's what I understood from your PPT. The thing is that every year there's one thing that comes up.
Yeah.
If because in last year there was another team that topped up. Today there's another team that's going to top. Every year that's it's not the same. It's not the same, right? So because of it, because you're avoiding thematic, don't you feel that you're missing the thematic rally that goes different every year?
So we are avoiding thematics as a direct exposure, right? But let's say I had FIM. I did
Mm.
better than any other two-wheeler investment would have, right? So I played EV, there was an underlying thematic that everybody else misses, what I can say, right? Because every single bike out there was shifting from halogen to LED. It was a big shift because all of a sudden my realizations are going 2x for the same amount of bikes, for the same, headlight. So we will always have exposure. So uh, I do have a company today that could be relevant for data centers in my portfolio, but it is not a data center alone company. It has a base business that does really well, and it will also service that. So I'll give you an example. Everybody talks about AI and impact on IT and AI and impact on XYZ consumption app and startup economy and yada yada yada. Nobody is talking about AI and the impact on pharmaceutical industry in India. The
Mm.
reality is, there's this very interesting company that Google had funded called AlphaFold.
Oh.
AlphaFold uses AI and has been able to map out 220 million proteins, which are essentially every single protein known to man today. What that does as a result, along with all such innovations that are coming up in Gen AI, is that drug discovery process, at least on paper, the preclinical level of drug discovery has become much shorter, therefore much less expensive. All these PhD guys or venture cap funded like single biotech companies in the US uh, have this ability now, but they don't have the manufacturing setup. And guess where the world's largest API factory is today in the world? It's in Vishakhapatnam, right? So there is a massive shift that will happen because all these contract manufacturers all of a sudden will see a lot more development work coming there. So I am playing AI. I mean, my portfolio will have 15% exposure to this, but it's not in the traditional sense that people are thinking of AI because I see this as a far more sustainable story. And there are very few industries where India can say we have a manufacturing edge over everybody else in the world. Pharmaceuticals is probably one of them. So we are seeing the impact of AI over there in the contract development and manufacturing companies in pharma. And you can see it. All of them have doubled their gross blocks in the last 2, 3 years. All of them have, most of these stocks are, at 52-week high or 10% from their 52-week high, which is unreal in this market, right? So clearly the market's also appreciating it. But we will have such companies.
So
And
basically, you're not directly into that.
correct,
Instead of the sub theory or or the sub theme, you're still invested in it, still gaining that part.
correct.
I got it. So I'll just take one question from audience is that how many stocks do you hold in this portfolio? And what is the size of the portfolio and how have you been managing the portfolio since its inception? Probably more about your fund, if you could take two lines about it.
Sure. Our way of managing this fund is find businesses, like I said, that grow faster than India's nominal GDP. Within that, find companies that are gaining market share and that are able to do so at incrementally better return on equity. Gaining market share companies in businesses that are becoming more relevant in India will always have expanding margins, reducing working capital cycles because udhari pe kam kaam karna hai, you don't have to give as many discounts, etc., etc. So there are all these small benefits that sort of start accruing to you. Uh, Now, we have a portfolio of 18 to 20 such companies for every single client. Across clients, we have about 24 companies today. The reason for that number to be a little bit higher than per client basis is, a client that comes in today versus a client that came in 5 years before, there might be some slight changes that might be there. But, 85%, 85% of the portfolio remains the same. And we do active deployment. So when the money comes in today, we see as per today's prices, what kind of allocation we would like to do and how we would like to proceed, so on and so forth. But otherwise, we prioritize our research basis our understanding of these narratives that okay, this seems more immediate than something else. This seems like it's happening right now. Let's focus on this. But once we focus on the company, we spend about a month or so on the company. We meet managerial level people, or just one level junior to CXOs. We've realized CXOs are all trained to give answers to fund managers. So we like to meet those people who are actually running the shop floor, who are more excited to talk about their work, but generally are never given the space to really boast about their work. We feel that there's a lot many more genuine responses that we get at that point of time. We do our pre-mortem, etc. So we write down a sell thesis before we buy in that. If so and so happens, then we don't have any defensible answer, then we have to exit. So we try to, as much as possible, remove emotions out of the equation, work with this process, and make sure that regardless of the kind of market we are in, that we stick to this process.
Okay. When you talk about your portfolio, let me just take one question from it is that one of your portfolios, which is TIOS, which stands, it has 20% cash. And here you're going to talk about active deployment as well. So do
Right.
you feel that, because you have, cash as 20%, is it because you feel market is insufficient for you to deploy it amount, or you're waiting for better opportunities?
No, so TRS, I think in the last, so you'll see this in the Feb data, like the numbers would look very, very different now. So that would be down to about 8% cash. We had gotten
Okay.
some new clients over there. I think that is where the cash level looked sort of artificially inflated because, the newer clients, we take about a month or so to deploy money. And that's a large cap oriented fund that's run by my colleague, Mr. Sheetal Malpani. So, when the money comes in, you don't deploy it day zero. Like you figure out your strategy, what works best as per your strategy and deploy it over a period of time. So that number would have come down to 8-9% now.
Okay, okay. So, with all this, so much of information poured on us, we never knew that we have already passed the timeline. It was supposed to be 5:30. We were already 2 minutes away from it. But still, there are a lot of questions that, for me to take before we could leave. But for the benefit of, all the investors and all the participants, I would like to take a bit of the questions offline. So
Sure.
before we could leave, it's unfair if I don't ask you this one last question about FII selling and DIIs, being the backbone of our Indian equity market. So
Right.
what is your outlook on it? If you could tell in 2, 3 lines.
Uh, FIIs, so we are a very small part of their portfolio. The moment they see currency stabilizing and appreciating a little bit, they'll come back. They'll come back uh, also as a antithesis to their, oh, we only want to buy AI stock theories. But I feel that FIIs should start possibly coming back now if the rupee, because for them it's a 2, 3, 4% allocation in their fund. Usme they have to take a call on the company, they have to take a call on the currency, on the macros, etc. They'll be like, yeah, let the currency stabilize, then we'll look at it. So the moment the currency stabilizes, we've seen, 18 months of sustained outflow. So all the stars are otherwise aligning for them to come back. Q3 results were very strong. Like I said, prices are slave to quality earnings. Quality
Mm.
earnings was very strong. Um, in Q3, and I believe Q4 to be the same. Um, Having said all of that, I think that the only question they're all thinking about is now, let the currency stabilize and we'll take a look at it because they also want to hedge their excessive AI bets also. They also realize that this is getting quite out of hand and ridiculous. Adjusted EBITDA 5 years hence are getting 400, $500 billion valuations as if it's nothing. So I'm sure they'll come back probably in the next 5, 6 months.
And also, historically, quarter 3 performance always quite better because of all the festive running on the
But
months.
Akshara, that's there in the base as well. No, last year also Diwali was in quarter 3. So ऐसा नहीं है कि this time we have that added tailwind of GST.
Yeah.
So I love it when companies come and tell us that this time we've not done well because Shraddh tha. I'm like, तो last year भी तो Shraddh tha. Like, how can you say this last year when the Shraddh was in a different quarter, you use it as an excuse somewhere else. You never came and told me that Q2 did better because Shraddh had gone into Q3. So, but yeah, Diwali is there in Q3 every year. So every year Q3, you're right, does well, and Q4 does even better because March finalization, people always push on sales.
Yeah. Okay, with that, that was a lot to take home today on a Friday evening. Thank you, ma'am, for educating us, and also for the participants. Before I could, call off, I would request you. These questions will be mailed to you. I request you to take some time to answer these questions and send back to the respective people so that they feel very much relevant to that.
Sure, absolutely.
Thank you, ma'am. Thank you for your time, and thank you, audience.
Thank you so much, Akshara, for having me.
Yeah, thank you.